Hello, this is Tyson Clayton, and it is May 7th, 2015, about quarter to 2, and I wanted to do a quick video on the earnings plays that I'm looking at today and explain some of the thought process behind it. I've had a couple questions about my earnings plays, and some of the questions were, Tyson, it seems like you go to the call side. You're buying naked calls a lot of times. Is that not a very low probability trade? And the answer to that is you can go through periods of losers and low probability, but overall, in very detailed long-term analysis, and I did long-term analysis on hundreds of stocks from 2007 through 2009, so a very bearish market, and from 2012 through 2014. This is based on my history also. But analysis shows that the average stock for earnings has a positive response about 50.5 to 51% of the time. So there is a slight edge to the bullish side during earnings. It just randomly. And if you think about the psychology behind that, it makes sense. Companies are probably a lot of companies tend to sandbag a little bit. They tend to lower the expectations, and then they want to put their best foot forward during the earnings and the earnings calls. And a lot of the market responds not necessarily off of the earnings, but off of the forward guidance and what the CEOs and CFOs are saying. So again, we do have a slight bullish bias historically on earnings as an aggregate, okay? But I have, over my history, I have actually found an edge in a pattern that happens that gives us about a 4 to 5% edge. What I mean by that is when certain things happen, and I'm going to do an earnings class, it's going to kind of couple on top of the options course that I'm working on. And I'll be rolling this out, and details of it will be coming soon. It'll probably be like a webinar class, but I'm going to go into details in this. But I found a pattern and an edge that gives the trader a 54 to 55% probability that we're going to have a positive earnings response. All right, when these certain things happen, I'm not going to go into detail of what those are, but now that's my edge. So historically, I expect to win at about 50, between 50 and 55, 56% of the time. Over long terms, 54 to 55% of the time. We can go through some losing streaks, but here's what I want to do. When I find this pattern, and again, I'll go over that pattern more in detail when I do this earnings class. When I find that pattern, I then want to take advantage of taking a bullish position, all right, because I have the edge, taking a bullish position on undervalued options. Now, TSO, for example. TSO reports earnings after the bell tonight. Well, what I know about this is I know historically, I know what the moves are. Okay, so TSO, these are the last four earnings that TSO has had. Last earnings it moved 8.61%, and two earnings ago 7.19%, and this is max move. So this is from closing price the day before, and then all day tomorrow. What's the max amount that TSO moves? So from the closing price to the highest move, whether it's up or down. So these are the max moves. So 8.61, 7.19, 5.27, and 2.41. So I know, so I get an idea of how far TSO historically should move. But I've created a spreadsheet, and again, I probably will give this spreadsheet out when I put this class on, the earnings class on. I've created a spreadsheet to help me, and there's an algorithm behind that gives me an idea of how far something should move based on the historical moves, and then putting a little higher weight on the volatility, the current volatility, and the lowest move it's had. So long story short, TSO is currently trading at about $88.78. So the at the money call for this week that expires tomorrow, Friday, is trading is $89. Okay, so that's the $89 at the money call. Well, based on my algorithm, I assume that TSO should move 5%, about 5%. That's my projected move. Well, at current price, if it moves 5%, all right, if it moves 5% up, okay, and I'm taking a bullish position, I'm going to buy a call. So if it moves 5% up, then, and I buy the $89 call, that call is now going to be worth $4.22. How do I know that? Well, because again, if it's trading, if TSO is currently trading at $88.78, and we get a 5% move higher tomorrow, let's say that's the max move, it goes up to 93.21, 93.22. Well, it's going to be up to 93.22, but I bought the $89 call, so therefore my call will be worth $4.22 if we get that move in my direction, okay? So here's the thing. So how do I know if it's undervalued? Well, I look at the current pricing of that option, and find out, is it undervalued or not? And the reality is if it should move 5%, which means it should move up about $4.22. If that's the case, then that call should be worth about, or should be traded at about $2.11, because it should be about a 50-50 chance of it moving up or down. Even though I just told you there is a historical bias to the upside. And this TSO shows the pattern that actually gives us a 4 to 5% probability to the upside historically. So, long story short, this call should be priced minimum at $2.11. Well, right now, as I'm speaking, it's priced at $1.20. Okay, so I'm expecting it to move. I'm expecting TSO to move 5%. And I think it's going to move up based on the patterns that I've seen. And I think we have about a 4 to 5% odds in our favor. That means that if I'm willing to take this trade, I'm willing to lose the entire $1.20, and I might lose that 50% of the time. I got to be okay with that, because when I win, my target is going to be $4.22. What does that mean? Well, if I get in for $1.20 and I make $4.22, right, or the call is now trading at $4.22 because I get a move higher, and I get my move, well, my profit is then $3.02. So think about this. I'm risking $1.20, the cost of the trade, to make what I assume is a fairly, I think the move that we're going to get is going to be about 5%. Based on my algorithm, I think we have about a 4 to 5% probability edge, right? So about a 55% probability of it moving higher. I'm buying it for $1.20, and I think I have the potential, a decent potential, to make $3.02. So I'm risking $1.20 to make 302. Ultimately, my target's going to be 422, giving me that profit. So here's my trade. TSO meets all my requirements. It gives me that edge. I'm buying the calls, the $89 weekly calls. I want to pay $1.20 or less. If I can get them for less, then great. I'm going to buy this about 15 minutes before the close, half an hour to 15 minutes before the close. And I'm willing to risk the entire $1.20, okay? My target is going to be $4.22, and I'm hoping that it pops up, and at the open tomorrow, I get out because TSO moved higher, and it's higher by more than 5%. They also, think about this. TSO, I'm expecting it to move 5%, and if it does, I make a profit of 302, right? But look at this. Historically, last earnings it moved 8.61%. What if this moves 8.61% up this time? Well, if it moves 8.61%, then this call, all right, is going to be worth about $7.50. So I'm only expecting to make about $3, but I think I could potentially make up to $5 or $6. So I'm not dependent on that, but I think that could potentially be the case. So anyway, this is a spreadsheet that I've created. I probably will get this out to members and to those that are take part in that earnings course that I'm going to be putting on in the future, and I'll disclose the pattern that gives me a 4 to 5% edge, and how I do it. But long story short, TSO, $89 weekly calls, pay $1.20 or less. My target's going to be 420. And if this contracts here, this is just showing that if per trade you were willing to risk $1,000, you would essentially do 8 contracts. Just round it to the nearest contract. So that's my first trade. I've got another trade, which is in Jazz Pharmaceuticals. I love this stock, by the way. This is a very high quality biofarm stock that's actually got a bunch of cash, and it's trading at a very cheap valuation. But I'm not going to trade it for a long-term investment today. I'm going to trade it for an earnings play, because same reason. Here's the last 4 earnings responses, and here's my expectation of a response. I think it's going to move. Jazz is going to move 6.41% or 6.42%, let's say, and I'm basing that based on my algorithm. Okay, so I think it's going to move 6.42%, and the 177. So it's trading at 176.50. The 177.50 call right now is trading at $3.20. So that's cheap. Why do I think that's cheap? Well, let's do the math on this. All right, it's trading at 176.50 right now, right? Again, let's just say it's a 50-50 chance, right? Which we know Jazz actually meets my requirements, that pattern that gives me the 4 to 5% edge. But let's just say it's a 50-50 chance. Well, I think it's going to move 3.4 or 6.42%. So trading at 176.50, if it does move up 6.42%, then Jazz is going to move all the way up to 187. Let's assume it moves up to 187.83. Well, I'm going to buy the 177.50 call. That means that I buy in that call for $3.20. But if I get my move, and I get my move as much as I think I'm going to, then my call is going to be worth $10.33. So long story short, I'm risking $3.20, the cost of the call, to make, and I think I have about a 4 or 5% probability of doing this, to make up to $7.13. This is a phenomenal trade. Not only that, but it has that potential for upside surprise. If you look 3 earnings ago, it moved 10.41%. Well, what if Jazz moved 10.41% this time, right? Well, if it did, then that would mean that that would mean Jazz would essentially be up to 201.38. Well, if I bought the 177.50 call, now my calls I bought for 320, all right, $3.20, are now worth $23.88. That's a huge windfall. Can it happen? Yeah, it can, and it has. I'm not depending on it, right? I'm just thinking we're going to get this move minimum. Could be up, could be down. If it's down, I lose. If it's up, great. But I got an edge. All right, I think it's going to move this, which means if it does move my projected move, I'm risking 320. My profit potential, if it moves that much in my direction, will be $7.13. So I'm going long the 177.50 weekly calls. I want to pay $3.20 or less for them this week's calls, and my target is going to be $10.33. Now, what I want is I want to wake up and be able to close these out right at the open for a full target or even higher. Like happens, it happened in Amazon, it happened in Netflix, it happens fairly often, not a ton, but fairly often. Don't count on that, but it can happen. So again, both of these, TSO and Jazz, have that pattern right now that gives me a 4 to 5% historical edge. I'm going to show that in the earnings course that I'm going to be putting on. And then I'll probably be giving away this spreadsheet too that has my algorithm that gives me an idea of what the projected move should be. And this is how I come up with, is something fairly priced or overvalued? Is it undervalued or overvalued? These are substantially undervalued calls, and I believe I have a 4 to 5% probability of it moving higher, or edge of it moving higher. Therefore, I want to buy them, take advantage of that. So I'm buying the Jazz 177 weekly calls for $3.20 or less, target at $10.33. Doing the same thing in TSO. I'm going to buy the $89 weekly calls for $1.20 or less, with a target of $4.22. Think about this. Every single person out there needs to learn how to trade options, because there's no other asset class in the world that can turn $1.20 into $4.22, or maybe even much higher, overnight. Options can. Anyway, thank you for your time. Thank you for listening. If you have any questions, email me at info@wealthytrades.com.